What's up everyone, this is Patrick Liu, and today we are going to talk about the only Chinese company that I'm interested to invest into. Typically, I would just stay away from most of the Chinese companies. Doesn't matter if it's Alibaba or JD.com or Tencent or any of those big companies. But today, this one is actually a pretty small company. Their valuations is only around 9 billions, and I love this company. I love this company so much. And that is Bilibili. Ticker symbol Bili. We like to call it as Bijia in English, B-site. So I'm going to refer this company as B-site for the rest of the video. A lot of people calling B-site as the YouTube of China. Well, I mean, they are very similar, but they are also very different. B-site is the biggest community for ACG, anime, comic, and gaming in China. When they first started, they focused on ACG content. Nowadays, they have expanded to other areas like vlog, tech review, beauty, esports, or pop culture, and much more, just like YouTube. Well, ACG content is still a huge part of this whole community. But recently, I think 3 of my friends told me that they are learning video editing on B-site, which is pretty amazing. Their main audience are Generation Z, people who born between 1990 to 2009 in China, which is represent 24% of the total populations in China. Let's take a look at their advertising segments. Unlike YouTube, generate most the money from ads and membership. It only represents around 12% of B-site's total revenue, according to their recent earnings. But also, unlike YouTube, you don't see ads before a video or during a video that interrupt you. I know you hate that, right? You only see ads when you open their app or in some other places that won't interrupt you. Well, in my opinion, B-site is in a very competitive industry. They are not only fighting with companies like iQIYI or Tencent's Video, they are also fighting with companies like TikTok or Weibo for screen time. So giving the user a better experience can help them to grow faster. If other segments like live streaming, like membership or selling merch can grow to a point that they don't really need to cut on the ads revenue, then they can always provide a better viewer experience than others. Well, if they can't really grow to that point, they still have this option, and this option can generate tons of money for them. Alright, now I really need to shit on iQIYI's ads. Alright, for me to watch just a 2 minutes video, I need to watch a 90-second ad. That's just annoying. By the way, this is 9 in Chinese. Well, B-site is actually also a gaming company. Matter of fact, the revenue from gaming represent more than 50% of their total revenue, according to their recent earnings. Even though gaming is a huge part of their company, but I wouldn't consider B-site just a gaming company. The gaming segment has grown double digits year over year. But if you look at the percentage of how much the gaming segment represents the total revenue, it's actually declined year over year from more than 80% in 2017 to just 53% in 2019. Well, I mean, 53% is still a lot, it's more than half, but as you can see, it's declined year over year. And this just shows that the company is actually focused more on other segments. The gaming segment will always be there and will always be a big part of this company, but it's the other segments that I'm really interested into. Let's take a look at some numbers. As of right now, I'm recording. Oh shit, I don't even know how much they are trading at. As of right now, I'm recording. B-site is trading at $27.73. Let's take a look at the balance sheet. Usually when I just start researching a company, balance sheet is probably the first thing I'm looking at. Especially these days when the global crisis is happening, a good balance sheet seems to be very crucial. Keep this in mind, the number I'm going to disclose is in CNY, means Chinese money. They have almost 5 billion in cash and cash equivalent, and 3.1 billions in short-term investment. So the total cash they have is roughly around 8 billions. Next, let's look at their current liabilities. They have about 4.27 billions current liabilities, which means that they can cover all of their current liabilities with just their cash. And on top of that, 1.37 billion of those current liabilities are deferred revenues. Deferred revenue is not something that they need to pay out as long as they can provide the goods and the services. It's just the money they collected in advance. And next, the total liability. They have less than 8 billion total liabilities, which means they can pay everything that they owe with their cash and the short-term investment. I'm actually impressed. Before I look at their balance sheet, I thought it's going to be shit. Turns out it's not bad. And since they are one of very few companies that are actually benefit from this global crisis, since everyone just locked down at home, I think they are in a pretty good position. Next, let's look at their income statement. Since they are still losing money year over year on their bottom line, so let's just focus on their top line, on their growth. As you can see, this is a very impressive growth that they had for the past few years. In 2016, they only have $500 million in revenue, but in 2019, they have almost $7 billion in revenue. They more than 10 times their revenue within just 4 years. Very impressive. The only thing I don't really like on their income statements is the cost of revenue. This number is way too high and only left the gross margin around 17%. If they want to be profitable in the future, they really need to do something to reduce this number dramatically. Well, now the question is, would I buy this company at current price? The answer is no. They are up almost 50% year to date, and they are trading around the all-time high. And on top of that, let's take a look at their PS ratio. Since they are still an unprofitable company, so there's no PE ratios to look at. Their PS ratio sits almost at 10. This is ridiculous high. Let me give you some idea of how high this is. Tesla is a high growth, unprofitable company, and recently their stock price are growing so fast, but their PS ratio only sits around 5.4. Yeah, I said only. Uber is a high growth, unprofitable company, and their PS ratio only sits around 2.5. Maybe you can argue that Tesla and Uber doesn't really have the same growth as B-sides, but for me, the PS ratio sits at almost 10. It's a bit too high for me. Well, I would probably nibble in a few shares if the price goes under 25 or low 20s. And if the price can go under 20, that's when I will start buying this company heavily. Even though I said heavily, but I wouldn't pass more than 10% of my whole portfolio. Since it's still a Chinese company, lots of uncertainties there. Anyway, don't buy or sell based on what I said. Do your own research, have your own judgment. Destroy the like button if you enjoyed this video, and subscribe if you want to see more. And until next time, peace. Shh.